In example 7.1, we looked at the scenario where there was a value adjustment required on the land of the subsidiary at acquisition date, and the subsidiary did account for this value adjustment in its separate financial statements before we consolidated. As a result, there was no business combination valuation journals necessary as part of the consolidation process. Now we want to ask, would it have made a difference if my consolidation was done at 31 December 2010 and the subsidiary sold this land that was revalued at date of acquisition for 110,000 Rand cash during 2010? The answer is yes. The journal entry that the subsidiary would have processed in its own accounting records at date of sale of the land would have been as follows. Debit bank for the proceeds received, credit land to de-recognize the land, and note it's measured at 120,000 Rand, and you balance to a loss on sale of asset of 10,000 Rand. So that is what would be included in your starting point when you now consolidate. No land, loss on sale of land, and bank 110,000 Rand. But something else that the subsidiary has to process when the land is sold comes from the requirements of IAS 16. When the subsidiary sold the land, the subsidiary also had to realize or transfer the revaluation surplus in its separate financial statements to retained earnings. That is the realization of the revaluation surplus on date of sale, and this happened in the separate financial statements of S. However, this revaluation surplus forms part of the at-acquisition equity of the subsidiary that is eliminated against the investment in the subsidiary during the consolidation process. So from the group's perspective, this revaluation surplus no longer exists. It was eliminated. Consequently, this surplus cannot realize in the consolidated financial statements. But the trial balance of the subsidiary, being my starting point for the group numbers, shows this realization and the effect thereof. So the following consolidation journal entry is necessary to reverse this realization. And that would be a debit to retained earnings and a credit to the revaluation surplus. So you are ultimately reversing the realization that was processed by S. Because this revaluation surplus was de-recognized in the subsidiary's records and will therefore in future periods not form part of the separate financial statements of the subsidiary, being my starting point every year that I consolidate, this journal entry would have to be repeated every single year. It takes away the realized portion out of the retained earnings of the subsidiary. It creates this revaluation surplus again every year so that you have it available to eliminate in your at-acquisition consolidation journal entry. The consolidation journal entry that you will process in all future periods will be a debit against the retained earnings opening balance of the subsidiary and a credit to the revaluation surplus opening balance of the subsidiary.